So up to 2010, 2011, it was more than 50% of total corporation tax. It has dropped a bit in 2011, 12. I'm guessing that is partly due to the fact that we lost some large international business companies, but also that the top rate was reduced starting from that year. Life insurance companies also account for a significant proportion of tax. One of the concerns that was raised with given the high dependence on the international business sector, I guess this was a suggestion that we need to make sure that the tax base or that the tax collected from the domestic sector is large enough, because the international business sector, the tax collected is so susceptible to what happens in the home jurisdictions of the companies that are operating here. The IMF also observed that our standard corporation tax rate of 25% is competitive compared to other jurisdictions. And then we also have fairly generous capital allowances, tax credits, and further incentive regimes. So all of that is saying that corporation tax could be higher. So these are the corporation tax recommendations. Currently, the standard rate is 25%, but there are some industries and sectors that benefit from a 15% tax rate. So they're saying because of all those other generous deductions, we could just tax everybody at 25%, all domestic activities. They thought the current system of capital allowances was a bit too complicated. So they're suggesting that we do it on the declining balance over 5 to 10 years. The investment allowances, they're saying, can be eliminated because there's very little evidence that those help to increase investment in the country. Similarly, the tax credit allowances for exports and foreign currency, and those are also, they're saying, potentially not in compliance with WTO requirements, so we should be looking to phase them out anyway. And then currently, they're saying taxpayers can artificially inflate interest expense so as to reduce tax payable. So they're proposing that we introduce thin capitalization rules, which are common in other jurisdictions. Finally, tax incentives for investment. There's currently an extensive regime for tax incentives, whether under specific legislation such as the Tourism Development Act, Small Business Development Act, but also the Minister of Finance can authorize exemptions from duty and VAT and et cetera on a case-by-case basis. This, they're saying, undermines the coherence of the tax system, so it erodes the revenue base. It makes the system opaque. There's too much scope for discretion, and then you're not quite sure why the discretion was exercised in one case and not in another, which could lead to corruption or increase the risk of corruption. We actually seen an increase in investment as a result of having all of these incentives. So with the companies that were attracted by that have come anyway, with our local companies investing more because of those incentives. There's actually a slide in the report, an appendix in the report, with the 10 most common arguments against tax incentives, so we can see if Jeremy agrees, but it looks like the economists generally are not in support of tax incentives. I phrase it that way so you can more easily disagree. But this is the argument. Certainly IMF economists are saying that the evidence does not support the benefit of tax incentives. The IMF then looked at the revenue foregone, the lost revenue as a result of these tax concessions. Import duties in 2012-13 about 150 million, in concessions, excise tax about 77 million, VAT 247 million. And they pointed out that the duty concessions were almost equal to the duty revenue collected. This was a slide that I spoke about in terms of comparing the average tariff rates in Barbados to other jurisdictions. And they included this slide because they're saying the high tariffs lead companies to make requests for exemptions from the government. So Barbados is actually third again in the rankings, and the two that are ahead of us, Bahamas and Bermuda, have no VAT, while we do. So the recommendations are no surprise then. No new tax holidays. Minister of Finance should use his discretionary powers sparingly and minimize VAT and excise tax concessions. We can reduce the incentive towards concessions, or the need for concessions, by rationalizing the tax structure, by applying a few simple bans with lower rates. So this applies to the excise taxes and the import duties. And finally, that we should have an annual tax expenditure report. The tax expenditure report would show the revenue foregone as a result of all of these concessions, and that should be part of the annual budget process, meaning that it should be laid in Parliament and approved by Parliament.